All right, let's dive right in. Today, we're setting sail into the world of GE Shipping, one of India's biggest players in the maritime game. So, the big question is this a stress-free investment opportunity, a ship loaded with treasure, or is it sailing straight into a storm? Let's find out. So, let's kick things off with the one question that really gets to the heart of this whole thing. Is it actually possible to buy India's top shipping company for less than its ships are actually worth? I mean, it sounds almost too good to be true, right? Well, let's see what the numbers have to say. Okay, so cutting right to the chase, the research we're breaking down gives three big reasons to be optimistic. First, that valuation gap we just mentioned, the company is on sale. Second, it's an absolute cash machine, and it's been using that cash to pay down debt like crazy. And third, a bit of a weird one, but global tensions are actually creating tailwinds that are keeping shipping rates nice and high. And to put a number on it, the base case scenario here suggests a potential upside of more than 30%. Now that makes things a lot more interesting, doesn't it? But, where does a number like that even come from? Let's break it all down. First things first, we gotta understand the business. To really get the investment case, we need to know exactly how GE Shipping makes its money. So the company is basically split into two parts. The lion's share, about 85% of the revenue, comes from its main shipping business. The other 15% comes from its offshore segment. Now that part is all about supporting the oil and gas industry, and it's great because it provides a steady, stable income stream from long-term contracts. And make no mistake, their shipping operation is huge. We're talking about India's largest private player. They've got a super diversified fleet of 41 vessels, everything from massive crude oil tankers to dry bulk carriers. And here's the kicker. Their fleet utilization is running at nearly 100%. The ships are full and they are firing on all cylinders. Okay, so let's see how all that business activity translates into the financials. The research suggests this company is a financial fortress. But is it really? Let's dig into the numbers and see for ourselves. Wow, okay, this first number is pretty stunning, a 12% free cash flow yield. Now what that means in simple terms is for every 100 rupees you invest in the company at its current price, it's generating 12 rupees in cold, hard cash. That's after paying for all its expenses and investments. That is an incredibly healthy number. So what's a company to do with all that cash? Well, GE Shipping has been on a mission to absolutely crush its debt. You can see their debt-to-equity ratio has just plummeted, going from almost 1-to-1 just a few years back to basically nothing now. For all intents and purposes, this company is nearly debt-free. And all that financial discipline, it shows up right on the bottom line. I mean, just look at the explosion in profit after tax. It leaped from around 600 crores in 22 to over 2,600 crores just 2 years later. That incredible jump was fueled by what's known as a shipping supercycle, basically a perfect storm of high demand and sky-high freight rates. But hey, this wouldn't be a proper analysis if we didn't look at the other side of the coin, right? Every investment has risks, so let's get a balanced view and talk about the top three for GE Shipping. Okay, the big one, the elephant in the room, is the first one. Shipping is a deeply cyclical business. What goes up must come down, and those sky-high freight rates won't last forever. The other two risks to watch are a relatively low promoter holding and the fact that the company relies on a special tax regime that could, change someday. And here's the reality check on that cycle risk. The numbers already show that profits are down about 10% from their absolute peak. This is a pretty clear signal that the party might be winding down a bit. The multi-billion-dollar question is, how far and how fast will those rates fall? So you've got this fascinating picture, rock-solid financials on one hand, but this big, looming cyclical risk on the other. So what's a fair price to pay for the company? This brings us to the valuation. And this takes us right back to our very first question. The market price right now is around 1,440 rupees. But the net asset value, which is basically what you'd get if you sold off all the ships and other assets, is estimated to be around 1,600 rupees. Think about that. You're getting the chance to buy the entire fleet for less than it's worth. Now, that discount exists for a reason. It's the market pricing in that cyclical downturn we just talked about. When you put it all together, this valuation gap creates a really interesting risk-reward setup. In the base case, you're looking at a potential upside of about 32%. But if things go south in the bear case, the downside is limited to about 24%. So your potential gain is bigger than your potential loss. That's a setup investors love to see. So let's put all the pieces together and look at the final scorecard, which is based on some really interesting quantitative models. And on that front, the company looks fantastic. It gets an 8 out of 9 on the Piotrowski F score, which signals really strong operational health. Its Altman Z score is through the roof, which means bankruptcy risk is pretty much zero, and a negative Benish M score suggests the accounting is clean as a whistle. All of this analysis boils down to a final score of 78.9 out of 100. The research classifies this as a grade B opportunity. It's strong, for sure, but that big cyclical question mark is what's holding it back from getting a top-tier grade. And that really brings us to the final question I want to leave you with. Is GE Shipping a deeply undervalued, financially sound powerhouse that's just riding a predictable wave toward a big payday? Or is the tide about to turn for good, leaving today's investors high and dry? Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed companies should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free.